Welcome back to Money Pop. In recent updates, I have been signaling that a reversal in gold and silver is on the way and that we should still expect fresh highs in 2026. Yes, I have said we could retest $4,300 an ounce for gold and $66 an ounce for silver before we officially reverse and challenge the all-time highs again on the path to the longer-term price targets I have been sharing. That said, there is no rule that says we must revisit those levels. Based on the data I have been studying over the past 3 weeks, I think the bottom is in for both metals. That is exactly why I told you I was a buyer of gold, silver, and mining stocks in my last update. Time is running out on this pullback and consolidation phase. When we look at the fundamentals, despite all the volatility, with large moves up followed by large moves down, two clear trends stand out. The first is that central banks are spending more on gold, measured in US dollars, than ever before. Their buying is not weakening. It is not falling off the way mainstream financial media wants you to believe. On a US dollar basis, it is growing. For silver, the deficit in supply remains unchanged. There simply is not enough silver to fully meet market demand. Stockpiles are dwindling, and the physical price is moving up to reflect the mismatch between supply and demand. Critical mineral stockpiling by governments likely adds another layer of upward pressure to that situation. We are now sitting right on the edge of a breakout with multiple signals telling us metals could be close to their next leg higher. So in this video, I want to walk through the 4 things I'm watching this week, and in the coming weeks, ordered from least important to most important, that will tell us if this move up is the real deal. After that, I will cover the digital monetary reset and what it means for gold and silver when our money goes fully digital, because the data I have to share there will genuinely surprise you. Let us jump in. The first signal is the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. If you have been following along, you know that market bottoms for gold and silver tend to form when this ratio runs high, and tops form when the ratio gets very low. Between 2002 and 2011, this ratio chart formed multiple bear flag patterns, taking it from around 81 in the early days of the gold breakout in May of 2003, down to 33 by April of 2011, when silver almost touched $50 an ounce and gold had quadrupled. Fast forward to today, and the ratio chart is in the process of forming a second bear flag pattern, similar to the one between 2008 and 2009 that preceded the 2011 blow-off top. That tells me we are close to the next move. Specifically, I'm looking for a breakdown below the monthly closing support around 56.3, which is roughly where we closed in February. If we break below that level, it is a strong sign we are resuming the broader move higher in precious metals, with the ratio likely returning to the mid-40s, which marked the interim top earlier this year near 43 or 44, and also back in 2006. From there, we could continue lower into the 30s on the way to new highs in gold and silver prices. The second signal involves silver itself. Things look strong here, and we closed the week above $80 an ounce, which anyone would have been thrilled about just a year ago. Still, there is risk at the $83 resistance level because we have bounced around that line on at least 10 separate trading days so far in 2026. It has proven to be a serious technical ceiling. We need to clear $83 before we can test $90, and possibly the all-time high again once we recapture $100 an ounce. Since I bought last week, I'm happy to watch how this develops rather than chase. I want to see silver clear $83, preferably push to $84, and hold that level for 3 days, in line with the Morgan rule. The third signal, and the second most important in my view, is a breakout for gold. I believe gold will lead the way and print a new high before silver does. Zooming out on the chart, gold is forming a massive bull flag pattern. That pattern is a second factor confirming to me that gold's next big move, with a few pauses along the way, is towards $7,000 an ounce. Before that can unfold, we need a break out of the falling trading channel. Despite all the excitement around precious metals right now, gold is not quite there yet. Just as I told my Patreon members back in April, the signal I'm watching for in May is a move above the first resistance at $4,800 an ounce, where we have struggled recently, followed by a move above $5,000 an ounce. Clearing $5,000 by the end of this coming week or the week after would be a definitive breakout. That brings us to the fourth and most important signal, the US dollar index. I have been warning about a breakdown in the dollar since last summer, when I recorded an update from my hotel room in Turkey. As central banks continue to shift reserves into gold, real interest rates adjusted for inflation keep falling, and the Federal Reserve, whose balance sheet hit a new record high for 2026, just this past week, continues to print funny money. The bear flag pattern in the dollar is going to roll over. It will make a new low, and that will push gold and silver to new highs as the process plays out. Specifically, I'm watching for the dollar to move below 97 on the DXY and then eventually hold below the pivotal support at 96. Once that breakdown is confirmed, that is the most important signal that the reversal in metals is genuine. In a sense, this one move will trigger the other three signals to fall into place. Keep your eye on it this week and in the coming weeks as the main confirmation factor. If the dollar moves the other way, that does not mean the bull market is over. It just means we may need to see $4,300 gold first and $66 silver, although $70 is shaping up to be very strong support for silver right now. I did cover that in a recent update. The silver lining is that it would give you another chance to buy at those prices if you ignored my message last week. Now to this video's viewer question. If you have a question you would like me to address in a future video, please leave it in the comments. I read them all and I appreciate the thoughtful questions I have been getting lately. This week's question comes from Giant Hills, who wants to know what good your gold and silver are once the entire system goes digital. Let us clear one thing up immediately. In the countries where most of my viewers live, the overwhelming majority of financial transactions are already digital. Poland, where I live, and the United States, where most of my viewers live, come in at the 29th and 30th spots respectively on a global list. Both have well above 90% of transactions done through digital rails like credit cards, mobile wallets, and online bank transfers. The shift into digital transactions is not ahead of us. It is not something we are moving toward. It began around the year 2000 during the dot-com boom, when a huge share of banking shifted online. The coming move into central bank digital currencies that we keep hearing about is really just an attempt to eliminate the small slice of transactions still done in cash, rather than a true digital revolution. I say that because all of the scary things people associate with central bank digital currencies, like tracking or freezing user accounts, are already done today by governments and institutions around the world. Just ask the Canadian truckers who protested during C-19 and experienced exactly that, or the many gold and silver